Hi everybody, I wanted to give a quick intro to chapter 15, which is long-term liabilities. So this is an intro meant to kind of break open the chapter, and we're going to discuss it more on Wednesday at the optional lab. I will have homework help tutorials for some of the homework, and we're going to be taking this chapter into next week as well, okay? This chapter deals with a type of financing called debt financing for a corporation. It is in contrast to equity financing, which we just looked at, okay? Now remember, one thing I want to kind of anchor us around. We're in the accounting formula. I don't want us to lose sight of the accounting formula, where assets equals liabilities plus equity. Remember that the accounting formula, the assets are the resources of the corporation, okay? Cash, inventory, supplies, land, etc. It's the resources that we use to run our business. The right side of the accounting formula is how we fund the resources. So in chapter 13, we looked at how corporations can sell stock, sell equity in their company, and in exchange get access to cash, right? We had that one problem in chapter 13 where a corporate a shareholder bought in and got stock in exchange for land, right? So equity financing is financing the business by using equity. Chapter 15 is we're going to be looking at financing the business with debt, okay? So chapter 15, we're going to look in specifically at bonds. Okay, we're going to dive into this topic of bonds. A bond is kind of like a share of stock. It's a financial instrument that an investor can purchase, and the investor will purchase it based on what, perceived value. And a bond's perceived value is based on, can you buy the bond today and maybe sell it tomorrow for a higher price? And by tomorrow, I mean tomorrow, next year, 2 years from now. So can you have kind of what we call a capital gain on the bond? The other way to make money on a bond is through what's called interest. So you can get a little bit of interest revenue by being a bond holder. Now what we're going to be looking at is in chapter 15 is we're going to look at this concept of bonds from the corporation standpoint, which means we are a corporation and we need to get access to $300,000 cash. We don't want to surrender any more equity. We want to maintain our equity. So what we're going to do is we're going to go to the bond market and we're going to sell $300,000 worth of bonds. And creditors are going to pay us money for those bonds, and we're going to get access to, I'm going to get into this in a moment, but the idea is we want to get access to $300,000 cash. And in exchange, we're going to have a liability called a bond liability of $300,000 as well. Okay, so that's big picture what's happening with this corporation. The wrinkle we're going to see with bonds, and this is a kind of a core concept, is associated with this interest rate. So every bond has an interest rate stated on it, and it's the rate of interest by which the corporation will pay interest revenue to people who own the bonds. So this interest is an expense to the corporation, and it's revenue to the investor. Now, I'm a corporation and I have put 9% on my bonds. It's printed on each bond certificate. Then I go out and I sell it to the marketplace. Now, once I go into the marketplace, my bonds are going to be competing with other stocks and bonds in the marketplace. And let's just think about other bonds for now. Some bonds are going to have a 10%, maybe 11%, maybe 12% rate of interest. These are higher rates of interest, which will get an investor a higher interest revenue going forward. So my bond at 9% is perceived to be not as competitive as other bonds that might have higher rates of interest on them. Okay? And by the way, part of this is a disconnect where the corporation does a whole bond issuance, this interest rate gets printed on the bonds, and then it goes out to the marketplace, and the market is constantly fluctuating. So these interest rates fluctuate depending on how our interest rate compares with the market. Our bonds sell at either a discount or a premium. Sometimes they sell at neither a discount or a premium. They sell, for instance, at $1,000. I have $1,000 printed on this bond. But we're going to look at this idea of bonds selling at a discount or a premium. When our interest rate is perceived to be not as competitive as other bonds in the marketplace, we sell at what's called a discount. And that's what this is looking at here. Our $1,000 bonds selling at $95. Interpreting this language, what we're saying is our $1,000 bond will sell at $950. We are selling our bond for 95% of its value. because investors aren't willing to pay the full $1,000 because our interest rate isn't competitive enough. We are going to unpack this more. We have 4 homework problems that look at this concept, okay? And we're also going to see bonds sold at a premium and also bonds sold at the stated value. Just know the interest rate is really important to understand. The bond in relation to competing bonds in the marketplace is important to understand. And we're going to learn how to unpack this language, okay? We're going to do this at the lab on Wednesday, and I'll also be putting together homework videos related to those specific problems so you can get kind of your assistance kind of working through the math. Okay, thanks, and I'll see you on Wednesday.